Brad Williams, Frugal Finance, buying and selling stocks. Buy and sell stocks, whether you use an app, transact online, or give orders to an investment professional, you almost always need to have an account or brokerage firm, also known as a broker-dealer. The few exceptions include when you purchase or sell shares directly from a company. Here's what you need to know about the wheres and hows of buying and selling stocks. Using a firm. Brokerage firms tend to fall into one of two categories, each of which offers different services and pricing structures. Full-service brokerage firms provide research as well as trade executions and might offer customized portfolio management, investment advice, financial planning, banking privileges, and other services. Discount brokerage firms offer fewer services, but as their name implies, generally charge less to execute the orders you place. Some firms offer a little bit of both, with customer tiers or levels that range from full service to discount, and others promote themselves as deep discount brokerage firms, offering lower fees, even zero commission trading on certain products, but few, if any, support services to investors. Deep discounters cater specifically to the do-it-yourself or self-directed investor. Which firm is right for you will depend on your goals, the amount of money you plan to invest, level of guidance you want, the cost, commissions, accounts, fees, etc. you're willing and able to pay, the range of products and services you want, and other factors. Understand what kind of investor you are. Are you a buy and hold investor who plans to keep an investment over an extended period of time? Or are you a trader looking to follow the short-term price fluctuations of different stocks closely and then trying to buy low and sell high? Active traders who engage in day trading might look for a firm that offers direct access accounts to route orders directly to exchanges or alternative trading systems such as dark pools or electronic communication networks. These services, which help traders find liquidity and offer high-speed executions, typically come with additional fees. And remember, short-term trading comes with other costs. If you sell a stock that you haven't held for a year or more, any profits you make are taxed at the same rate as your regular income, not at your lower tax rate for long-term capital gains. Placing orders, you can place buy and sell orders for stocks online through a mobile app or by speaking with your registered investment professional in person or over the phone. If you do trade online or through an app, it's important to be wary of trading too much, simply because it's so easy to place the trade. You should consider your decisions carefully, taking into account fees and potential tax consequences, as well as the impact on the balance of assets in your portfolio before you place an order. Once you place an order, your registered investment professional or brokerage firm system will route your order to an execution venue, which is where the trade will actually occur. Learn more about where stocks trade as well as the life cycle of an online trade. Buying direct. There are ways to buy stock directly through certain companies, and also have a company automatically reinvest stock dividends. Direct stock purchase plans. A DSPP allows you to buy shares directly through the company. While there are no brokerage commissions, the company may charge an administration fee. With direct stock purchase plans, stock is generally purchased at specific times, weekly or monthly, and you may need to own one or more shares of a company stock to participate. You generally invest a specific dollar amount or purchase fractional shares. Read the company's disclosure information to learn the specifics of its direct stock purchase plans. Dividend reinvestment plans, also known as DRIPs. DRIPs automatically reinvest any dividends a company pays out instead of paying you the dividend in cash. You can contact the company to enroll in a DRIP if it offers one. As with DSPs, read the disclosure information. You might also be able to direct your brokerage firm to automatically reinvest dividends from shares you have purchased through the firm. DSPs and DRIPs are usually administered for the company by a third party known as a shareholder services company or stock transfer agent. Buying on margin. When you buy stock on margin, you borrow part of the cost of the investment from your brokerage firm in the hopes of increasing your potential returns, which can magnify both your gains and your losses. For this reason, it's important to understand how margin accounts work and the risk associated with buying stocks and other securities on margin. Learn more about margin accounts here. Check out my long list of videos under the playlist Investing. Short selling. Short selling is a way to profit from a price drop in a company's stock. And like buying on margin, tends to be a short-term trading strategy. It involves more risk than just buying a stock. To sell a stock short, you borrow shares from the brokerage firm and sell them at their current market price. If that price falls, as you expect it to, you buy an equal number of shares at a new, lower price to return to the firm. If the price has dropped enough to offset transaction fees and the interest you paid on the borrowed shares, you may pocket a profit. This is a risky strategy, however, because you must still rebuy the shares and return them to the firm. If you must rebuy the shares at a price that's the same as or higher than the price at which you sold the borrowed shares, after accounting for transaction costs and interest, you will lose money. And generally, the longer you wait to purchase shares, the more you will be paying in interest to your brokerage firm. Because short selling is, in essence, the sale of stock you don't own, there are strict margin requirements associated with this strategy, and you must set up a margin account to conduct these transactions. The margin money is used as collateral for the short sale, helping to ensure that the borrowed shares will be returned to the lender down the road. Often discussed in connection with short selling, short interest is a snapshot of the total open short positions existing on the books and records of brokerage firms for all equity securities on a given date. Learn more about short interest in this link. If you have any questions as it relates to buying and selling stocks, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.